In this lesson, you're going to learn how to calculate the mandatory debt repayments in a more advanced LBO model. Now, in the more basic model that we looked at, when we looked at our debt schedule for that model and created all of our assumptions and the formulas for that, the way that we did mandatory repayments here was pretty simple. Basically, we looked at our old debt balance and then we compared it to the annual repayment amount. And if the beginning debt balance was less than the annual repayment amount, then we just repaid the entire balance. If it was greater than that amount, then we repaid the annual repayment number instead. So for example, if we had 100 worth of debt and we were repaying 10 each year, we would simply repay that 10 each year for the mandatory repayment. If on the other hand, we only had a balance of 5 left, then rather than repaying the 10, we would repay the 5, and that would be it. So with the more advanced model, actually for the mandatory debt repayment itself, the same principle is going to apply. Really, the only added complication here is that we may have to borrow money for our revolver. Because remember, we have no guarantee that our cash flow is going to be sufficient to meet these mandatory debt repayment obligations. And so as a result, if we have a shortfall in cash, then we may have to borrow on our revolver here. We may have to draw on our revolver and actually start using it. So to see how this model works, let's first calculate the cash flow that's available for debt repayment here. So remember that the way we do this is we look at our beginning cash balance, we subtract the minimum that we always need, and then we add the cash flow generated during the year that we can actually put toward our debt repayment. So for the beginning cash balance here, let's go up to our balance sheet and go to the $5 billion of cash in FY 2009, the pro forma version of 2009 right here. Now for the minimum cash balance, remember, this is up in our operating assumptions. So I'm going to go down here and simply anchor this, take the negative version of it. And then the cash flow available for debt repayment, this is something that we've calculated on our cash flow statement right here. So it's really just cash flow from operations minus capital expenditures, otherwise known as free cash flow. So we have that. Now I can just add this number up to get to the subtotal before revolver. So this number is telling us when all is said and done, how much cash do we actually have available to put toward our mandatory debt repayments. And the issue here is that if the mandatory repayment total exceeds the subtotal before revolver, then that means that we're going to have to draw on our revolver and do some borrowing there, get a line of credit there, and start actually drawing on our revolver and using that to make some of these mandatory debt repayments. So as you might have guessed, the formula for the revolver borrowing required is going to involve our mandatory repayment total and then subtracting the subtotal before the revolver. So if you think about it, this formula should work most of the time, because if we have a certain mandatory repayment amount and it exceeds our cash flow available for this mandatory repayment, we simply subtract the subtotal before the revolver and we get to how much we actually need to borrow. This gives us our shortfall in cash flow. But the problem, as you can see if you press enter with this formula, is that we could end up with a negative. And so what we need to do here is check against this case, and we need to check and make sure that if this number is negative, as is the case here, in other words, our mandatory repayment total is less than our subtotal before the revolver. If that's the case, then we want to make sure that we are not drawing on our revolver at all. So to do this, we're going to use the maximum formula. And we're going to say the max of 0, and this number is what we need in terms of our revolver. So if you think about it, if the mandatory repayment total minus the subtotal before revolver, if that is positive, that means we have a shortfall in cash flow and we need to draw on our revolver. If on the other hand it's 0 or negative, then that means that we either have enough already or that our cash flow available actually exceeds our mandatory repayments, in which case we do not need to draw on our revolver. So in this case it comes out to 0, which makes sense intuitively, because as you can see, we have not even filled in anything for our mandatory debt repayments here, so of course the revolver borrowing should default to 0 in this case. For the total sources of funds, I'm just going to add up revolver borrowing plus subtotal before revolver. As with our sources and uses schedule, we also like to have a sources and uses for our debt schedule here, especially in more advanced models. It just helps us trace visually more easily what is actually going on here, and once again, where the funds are coming from to pay our debt, and then where they're going to. How much in mandatory repayments are we making, and how much in optional repayments are we actually making here. So now for the mandatory debt repayments, this is actually very simple and it follows exactly what we went through before with the basic LBO model. So I'm not going to go into a whole lot of detail. The basic logic is the same. We look at our existing debt balance and then we look at what the annual repayment should be. If the annual repayment is less, we repay that much. If the annual repayment is more, then we simply repay the remaining balance and pay off everything on the balance sheet. So we're going to use the min function here and start with term loan A. So we're going to look at the existing pro forma 2009 balance and then compare it to going up to our debt schedules. We're going to look at the term loan A number right here and multiply it by the principal repayment percentage down here. And you can see that if we want to be able to copy this formula down, we can pretty much do so because term loan A, term loan B, subordinated note, and PIK loan all follow each other on this schedule, which is in fact why I set it up exactly like this, to be able to more easily copy around these formulas. The only thing we need to do here to make sure it works correctly is that we need to make sure that the columns in this case are not shifting around at all. So I'm going to anchor the L part here to make sure these are not shifting at all. We want the rows to be able to shift because when we copy this down, we want it to shift to term loan B, subordinated note, and paid in kind loan. So I'm going to copy these formulas down. We see that as expected, we have nothing for subordinated note or PIK loan. These are both high yield debt, so there is no principal repayment. But for term loan B, we actually have a fair amount. 5% principal repayment is required versus 10% for term loan A. I'm going to sum these up. One other point I want to address here is that we are using positive signs for the mandatory debt repayment here, whereas if you remember in the basic LBO model, we are using negative signs. This is really just a matter of style. The reason I'm doing it in this case is because we have sources and uses, and I want to use positive signs here so that our total uses can match up with our total sources. It doesn't really matter what you do, but I prefer to do it this way in models just to make it more easy to see where the funds are coming from and where they're going to. If we were using negative signs here, in principle it would still work, but the problem is that then our uses would be negative and our sources would be positive. I like to keep them both positive to trace more easily what's going on. But with that in place, we can now copy all these formulas across. And so we have our mandatory repayment each year being pretty much the same going all the way across. Once again, this is primarily because we have not yet taken into account the changes on the balance sheet and elsewhere in the model. So once we do that, once we actually factor those in, these numbers will be changing. We see that there's no revolver borrowing required here, which is actually not unusual. Our cash flow greatly exceeds our mandatory repayment total. So it's not too unusual to see that in the context of an LBO model like this. Really, unless you're over leveraged or have so much debt that it's going to be close to impossible to repay everything, it's fairly unusual to see a drawn revolver, especially in an LBO like this where you have a huge company and it's not leveraged too aggressively. So it's not uncommon to see an undrawn revolver throughout the course of an LBO model here. We can see that even when we go in and adjust the balance sheet, we're still going to have an undrawn revolver because if anything, our mandatory debt repayments here are going to go down over time. So no matter what happens here, our revolver is going to remain undrawn. The only exception would be that if our principal repayment total went up, so if we had 20% and 10%, for example, or even higher numbers than that, then we might have to actually draw on our revolver here. But in most normal scenarios, it's going to remain undrawn for this type of LBO model. So that's how we set up our mandatory debt repayment in these debt and interest schedules. Hopefully you have a better idea now of the principle behind this, simply looking at how much cash flow is available, calculating the mandatory repayment based on the existing debt or on the annual repayment amount, and then seeing if there's any revolver borrowing required by comparing your cash flow, how much you can actually use to repay debt, to how much debt you actually have to repay each year. Coming up next, we're going to be looking at the final step of our debt schedules, which is the optional repayments right below this. And the formulas here get a little tricky because we have to take into account some more variables, But in principle, the concept is very similar to what we saw in the basic LBO model, which is that we look at any extra cash flow available after we've made these mandatory debt repayments, and then we allocate that cash flow toward making optional repayments and paying back some of the principal on bank debt earlier. So we look at any principal outstanding, and if we have extra cash flow, we use that to repay some of the debt optionally. So that's what we'll be covering in the next video in this course.